Okay, Assalamualaikum and hi. I bid my greetings to my lecturer, Mr. Shamsul, and everyone who watched this. Today, I'm going to present about the development of the art and science of corporate financial decision making on capital structure concept. Without further ado, let's continue to the first point. First, what is capital structure? The capital structure of a firm refers to the precise debt to equity ratio used to finance its assets and operations. Equity is a more expensive, long-term source of investment with greater financial flexibility from a business perspective. The ratio between a company's debt and equity is referred to as its capital structure. The ideal capital structure will be discussed by a company's management team and other interested stakeholders who will consider the appropriate ratio of debt to equity. Okay, next. What is capital structure process? The capital structure that will work best for a business must be decided separately by the owners and managers of that business. Should additional debt be financed to maintain ownership and increase returns? Should we use more equity financing to reduce our risk of insolvency and debt overload? These choices must be made on a case-by-case basis at both small businesses and large organizations. To compare the capital structures of various companies, ratios like the debt to equity ratio are widely utilized. Analysts can quickly ascertain how much of the company's capital structure is made up of debt versus equity funding as a result. Due to the numerous capital costs, it is essential for businesses to manage their capital structure. The capital with the lowest expenses would make up the majority of the company's capital structure in an ideal world. Finally, the expenses of capital must be balanced in a capital structure that supports the business model. For instance, a cyclical organization may not be able to afford to take on much debt, despite the fact that interest rates reflects a lower cost of capital than alternative like equity financing. If the business is unable to pay the loan interest throughout the slow periods of its business cycle, it must establish a capital structure employing alternative funding sources. Carry on. The second subtopic is how to determine optimal capital structure. By determining the ratio of debt to equity that reduces a company's weighted average cost of capital while increasing market value, the ideal capital structure is computed. The bigger the present value of the firm's future cash flows discounted by the WACC, the lower the cost of capital. Because debt carries less risk than equity, its cost is lower. Because interest payments take precedence over dividends and debt holders are given preference in the case of liquidation, the necessary return needed to compensate debt investor is lower than the required return needed to compensate equity investors. Debt is also less expensive than equity since businesses may deduct the interest they pay while paying dividends from their after-tax revenue. The amount of debt a company should have is capped because excessive debt increases interest payments, profit volatility, and bankruptcy risk. Shareholders will expect a larger return as compensation due to the elevated financial risk, which raises the WACC and lowers a company's market value. The optimum structure takes the company's cash flow volatility into account and involves deploying enough equity to lower the risk of being unable to repay the loan. Okay, move forward. The next subtopic is discussion on factor effect capital structure and capital structure decision. A capital structure is created to raise money strategically for an organization's growth. However, as the capital structure of any organization is affected by various elements, a firm's proper capital structure is chosen depending on several variables. The capital structure is influenced by a few variables in various ways. One of the factors is cost of capital. In simple terms, estimating the return that a company requires to the cost invested on initiative before considering it can be defined the cost of capital. Size and type of businesses are the second consideration. The size and nature of the company should be taken into account when selecting a capital structure. Okay, the state of the capital markets is the third factor. Another important factor that must be taken into account is the health of the capital markets. Capital market condition can be used to estimate the present cost of capitals as well as the risk involved with any new projects. Finally, consider the company's debt to equity ratio. The debt to equity ratio is a financial indicator that gives a precise picture and specification of the type of capital structure needed. Okay, the next subtopic is discussion on the financial distress. What is financial distress? A person or corporation is said to be in a financial distress when it is unable to satisfy its financial obligations because it is unable to produce enough revenue or profits. This usually occurs by high fixed expenditures, a high percentage of illiquid assets or revenue sources that are susceptible to economic recessions. Financial distress is typically present when a person or company is unable to pay bills, debt, and other obligations on time. It is crucial to comprehend financial suffering because of this. The financial statement of a company can be used by investors and other parties to evaluate its current and future financial health. Moving on, there are some signs for financial distress. A corporation may exhibit several warning indicators that suggest it is in financial difficulties now or soon. Unhealthy financial conditions inside a corporation may be indicated by poor earnings. In addition, if a company's revenue are stagnant or decreasing, its product or services may not be in demand on its present business plan. There is some ways we can think of to help us if we can't avoid it. Reviewing company plans is frequently one of the first steps taken by the business. This should cover both its internal operation and market performance as well as giving a deadline for completing all its objective. The location of cost cuts is another factor. This can include reducing worker or even management incentive, which are sometimes expensive to a company's bottom line. Some businesses could think about reorganizing their debt. Under this procedure, businesses who are unable to pay their loan can negotiate the terms of their repayment in order to increase their liquidity. They can continue their activities via reorganizing. Finally, there are similar solutions to those obviously proposed for people who are having financial difficulties. It might be prudent for people who are affected to cut back on costly for or useless spending on things like dining out, travel, and other luxuries. A different option would be credit counseling. A debtor who seeks financial therapy can avoid bankruptcy by having a counselor restructure their debt. Debt consolidation is an additional method to lower monthly debt obligations by consolidating high interest loans, including credit card balance, into a single reduced interest personal loan. The next subtopic is integration of tax effect and financial distress costs. Integration refers to a feature of tax system that use the same effective tax rate on income regardless of whether it is allocated to shareholders for personal income tax purposes or taxed internally by the corporation. Partial or complete integration are both possible. Meanwhile, distress cost is the extra expense such as a higher cost of capital that a company in financial trouble must pay. It is distinct from operating costs. According to Modigliani and Miller, when corporation taxes are present, a firm's value increases with leverage. The theory does not anticipate how enterprises would behave in the actual world, since this connection suggests that all firms should prefer to take on the largest amount of debt. As stated by other scholars, the value of the leveraged business is diminished by bankruptcy and associated expenditures. This is an example of integration of tax effect and distress costs. Based on the graph, when bankruptcy expenses are eliminated, the worth of the company is represented by the diagonal straight line. The firm's value with these expenses is depicted by the hump-shaped curve as the company switches from being entirely equity financed to having some debt. This curve increases due to the extremely low chance of the distress in this situation. The present value of the distress cost is very low. The current value of these expenditures, however, climbs steadily as more debt is accumulated. The rise in the present value of the tax shelter eventually match the increase in the present value of this expenditure caused by an extra unit of debt. B stands for the debt amount that will maximize the firm's worth. In other words, B represents the ideal level of debt. Beyond this amount, bankruptcy expenses outpace the tax shelter more quickly, indicating that additional debt has a negative impact on the value of the company. As debt is added to the capital structure in the bottom graph, the weighted average cost of the capital decreases. The weighted average cost of capital increases after reaching B. The best balance between debt and equity results in the lowest weighted average cost of the capital. Our analysis suggests that choosing a company's capital structure requires balancing the tax advantage of debt with the cost of financial instability. In fact, this method is usually referred to as the capital structures trade-off or static trade-off theory. The assumption is that each corporation should have a specific level of debt. The firm's goal debt level is set at this amount of debt. No specific formula for calculating a firm's ideal debt level has yet been devised, since the cause of financial hardship cannot be described precisely. The final portion of this chapter, however, provides some general guidelines for choosing a debt equity ratio in the actual world. What does equity cost means? A corporation considers the cost of equity when considering whether an investment satisfies capital return standards. There are some things that need to be looked out for, which is the return needed by either a business or an individual to justify an investment in equity is known as the cost of equity. Either the CAPM or the dividend capitalization model is used to calculate the cost of equity. Depending on who is engaged, the term cost of equity might relate to two different ideas. If you are the investor, the cost of equity is the needed rate of return of an equity investment. The needed rate of return on a certain project or investment depends on the cost of equity if you are the firm. The next subtopic is the pecking order theory. First and foremost, we need to understand fully about the pecking order theory. The idea of asymmetric information leads to the pecking order hypothesis. When one party has more knowledge than another, this is referred to as asymmetric information, also known as information failure, and it leads to an imbalance in the transaction power. More knowledge about the firm's performance, prospects, dangers, and outlook often resides with corporate management than with external users like creditors and shareholders. The pecking order theory hypothesis centers the net retained earnings financing, also known as internal finance, reduce information asymmetry compared to the external financing such as debt or equity financing, where the company must pay fees to get external financing. Internal finance is the least expensive and most practical type of funding. Debt insurance frequently signals an undervalued firm and a board of directors confident in the project's success. The issuance of equity, however, is a red flag that the stock is overvalued and the management is attempting to obtain capital through the diluting of company shares. Lastly, we'll be discussing about the signaling theory. The signaling concept was developed. Executive will initially issue debt and then stock as a last option if they think their company are undervalued. On the other hand, if management thinks their firm is overvalued, they will first issue share. The only other people with the right to a corporation's cash flows are its shareholders. Since interest payments are a contractual necessity, they take precedence above profits. Because of this, the way the prices of bonds and stocks respond to the information regarding financial structure is different. In his empirical investigation of the signaling hypothesis, Smith finds that companies that announce fresh stock offerings experienced an average 3% fall in share price. The report of a debt problem did cause a little fall in the share price, though. In addition, when debt was employed in place of equity, share price return increased by 14% as debt levels rose. Finally, the signaling hypothesis postulates that corporate executives would try to schedule the issuance of equity securities based on the market's assessment of their stocks. As an illustration, Baker and Wurgler find a strong correlation between corporate financing options and earlier equity marketplace. The capital structure of a corporation is simply the result of earlier attempts by management to timing the market. According to Bronnen et al., there is no proof that European managers communicate sensitive information in order to alter the capital structure. The available data indicates that the signaling theory is generally accurate. I guess that's all from me. Thank you.